Hello everyone, welcome to my channel. Today I'm going to be speaking with you on dollar cost averaging. If you watched my last video, then you should have heard me communicate that I now have mommy brain, and just so that I can get all the points, all the tangible points I want to discuss with you, I have been doing a couple of jottings. So if you just find me looking left, right, don't worry, I'm still here. It's just so I can have all the valid points I want to share with you, just because I don't trust my mommy brain. Anyway, what is dollar cost averaging? Dollar cost averaging is the way a buyer and an investor spreads their investment or their capital, right? So by investor I mean people like you and I, right? I don't mean like big companies, technical people, and nothing so high. It's just regular people like you and I. So anybody that wants to invest, anybody that wants to buy a share of something is called an investor. So I can use the word investor or buyer. For little beginners, I don't want those terms to scare you. That's why I've just put it as a bit of disclaimer, so that when I'm saying investor, buyer, you're not just thinking that, oh, this video is not for me. It's for every one of us. So everybody that is interested in financial growth, financial independence, want to learn how to maximize their profit and capital, or whatever it is, we want to just grow financially, then you should watch this video and you'll be one of the people I'm referring to as a buyer or investor, right? Baby steps into financial freedom. So this is one of my tips for you. So dollar cost averaging. So dollar cost averaging is a way of investing, is a way of buying stocks, a way of buying shares, right? So I hear some people say, oh, I don't know what to do, I can't buy shares, I don't have that money, I don't have that capital. But with dollar cost averaging, you can actually start investing. You can invest with as little as $10, right? So it just means when a buyer and an investor spreads out their capital over a period of time, right? For example, so instead of me, like for now, Tesla is about 200 and something bucks, so I'm interested in something like Tesla, right? And I don't have $200 to just buy it, right? I can spread my money. I can, if I have just $10, I can choose to be spreading $10 over 12 months, or I can say I'm going to spend $10 over 52 weeks in the year, right? So today, when it's 250, I spent $10. Tomorrow when it's 249, I spent $10. Next tomorrow when it's 200, I still spent $10. Of course, if I'm buying $10, I still don't have one share, but I have a fraction of it, and the number this each of this is buying is relative to the market cost. I'm going to use a more elementary example. I'm going to use something that is simpler, like 50 bucks instead of something really high, just so you can have an understanding of what I'm saying. So I'll just be giving you some pointers to make you really understand what I mean by dollar cost averaging. So as I said before, it's an investment approach in which the buyer and the investor distribute their purchases over a period so that the total investment that you have made is less affected by market timing. So that's what I meant by tomorrow is 250, next tomorrow is 249. So the timing of the market is not affecting you. So you're not like, oh, I should have bought it yesterday, I should have bought it. You are confident that your money is going to work for you when you spread it out this way, which is called dollar cost averaging. It also makes you committed, so you know that you are dedicating this amount of money into investing. Please forgive me for saying Tesla. It can be anything. It can be Pampers, it can be Huggies. Of course, Pampers name is Procter and Gamble, not Pampers, right? It can be anything. I will have a separate video on how you can choose kind of companies to invest in, right? So it makes you committed. It makes you know that, oh, you are spending a certain amount every time, right, towards your future, towards your financial freedom, towards whatever that investment is for you. So it might be for emergency fund, it might be to for estates, it might be for wealth creation, it might be for to transfer, whatever that thing is. You're sure that you're committed, right? That you're investing this particular amount over this period of time, right? It also makes it easier to transact in a market that is uncertain. So certain markets are very uncertain. Today they are high, tomorrow they are low. You're knowing that you're breaking even when you spread your capital over a period of time. Because whether there's a profit or a loss, you're just there, right? You're maximizing your contribution. Today when the price is high, your money might buy smaller shares. When the price is low, your money might buy higher shares. So, and everything just evens out. I will still give an example of this like down the line. It removes the time factor, also the struggle for timing, over knowing the perfect timing to buy, because you have other things you're doing, right? You have like your work, you have other things you're doing, you have your family, you have your hobby, you have like things you love doing, right? And so you might miss out on certain timings you put. Of course, there are some markets that you can do something called a time limit. Like I said, I will do all this in a separate video, right? So it helps you maximize time. It makes you committed. Those are the points I've made, right? And for somebody who cannot just sit down and be watching the market waiting for when the price is going to meet when you feel confident to, it helps you with that timing issue, right? It also allows you to stay committed to investing a particular amount of money. So I'm using $10 because that's like the bare minimum, right? I mean, you could do $5, you could do $2, but of course $10 is reasonable for somebody who just wants to start and watch how things are going, right? So it allows you to stay committed to that amount. Of course, on certain days, if you have more money, you can distribute it, right, in that same stock or somewhere else, right? So if tomorrow you have $50, you could choose to say, today I'm spending $50, I've been spending $10, or you could say, I'm going to just spend $10 out of 50 in this stock, and then let me try something else, right? So yeah, so it makes you spend that same amount over time. So the values of the shares also, like I explained earlier, like it can be high today, it can be low tomorrow. Eventually, when you look at your total portfolio, like your total market, your total share, like is a considerable amount for that price, right? So when the market drops, your money buys, you buy more, and when the market rises, your money buys less. So eventually it evens out, right? So in the example, when I make that example, I'm going to show you, right? So the example I'm going to be making is, you have $500 right now, and you want to buy shares, and the shares are like $10 per share. How much do you think your $10 is gonna buy you? So it's gonna buy you 50 shares. So if I have $500 and I'm looking at a particular stock, right, and I want to buy shares out of it, so, and that stock is going for $10 per share, I have 500. So 500 divided by 10, it means I'm going to buy 50 shares with 500. But if I say I have 500, I want to spread this 500 over 10 months. So it means I would be buying $50 every month, right? So that is dollar cost averaging. So 500 is a lump sum payment. If I just invest 500 into it today and it's $10 per share, I would only be able to buy 50 shares. That's a lump investment. But dollar cost averaging, like I've explained subsequently, you are spreading it out over a period of time. You're spending and you're fixed, you're committed to that capital amount, the timing, and it allows you buy like a wider range. You take advantage of when the market is high, you take advantage of when the market is low, so you even out, right? It makes you committed, it encourages you. It also removes the time factor where you have to be tracking when the price is fitting into what your budget is, right? So let's say this 500, we spread it over 10 months. Now let's look at it. So let's say for the first month, you bring the $50. So you're going to spend $50 for 10 months instead of 500 months. So you have $50 month one. And when it's $50, you're buying 5 shares. Like when it's $50, it's $10 per share. So you're buying 5 shares. Month two, it becomes $9.5 per share. How much do you buy with $50? 5.3. You know, before you bought 5 when it was $10, but now that it's 9.3 per share, you're buying 5.3. So that's 0.3 more than you will have bought with 5. The third month is $9 per share. So how many shares do you think you buy? 5.6 shares. The fourth month is back to $10 per share, you buy another 5 shares. The fifth month, it is $8 per share. Now you're able to even buy 6.25. Now compare 6.25 with $8 to 10 when it was $10 per share and you were only able to buy 5 shares. Then month 6 is now 8.5 per share. You're buying just 5.9 shares, right? 7th month, it becomes 9.5 per share. So you're able to buy 5.3. Then 8th month, 9.3 per share, 5.4 shares. 9th month, $7 per share, 7.14 shares. 10th month, 10.2 per share, now 4.9 shares. So I'm going to do it again, like how the dollar cost average works. So $500 lump sum payment, $10 per share, you buy 50 shares. $500, you do $50 over 10 months, which is still going to be 500. Month one, $10 per share, you buy 5 shares. Month two, $9.5 per share, you buy 5.3 shares. Month three, $9 per share, you buy 5.6 shares. Month four, $10 per share, you buy 5 shares. Month 5, $8 per share, you're able to buy 6.25 shares. Month 6, $8.5 per share, you're able to buy 5.9 shares, right? Month 7, $9.5 per share, you're able to buy 5.3 shares. Month 8, $9.3 per share, you're able to buy 5.4 shares. Month 9, $7 per share, you're able to buy 7.14 shares. Month 10, $10.2 per share, you're able to buy 4.9 shares. So now, with that same $500 where you will have bought 50 shares at $10 per share, when you do dollar cost averaging this way, right, and you spread it as $50, right, every month, the total number of shares you're able to buy with $500 at the end of 10 months is now 55.79 shares. So for each month you are putting $50, but the shares you're buying is different, so you're having different number of shares with that $50. So I hope that gives an elementary explanation to how dollar cost averaging works, right? So I mentioned some advantages of dollar cost averaging. I'll just like amplify them again. So it removes anxiety. So people who always panic, people who like don't know how their money is going to do in the markets, right? It removes that anxiety from them, right? And like it gives you peace of mind knowing that your money is working for you, right? And regardless of whether the market is high or low, like you're making this investment into it. So it's an efficient strategy. People will just panic with market fluctuation year a day. So because it takes off that fear with a fluctuating market. So it removes the emotional attachment you also have with money. You know, like there are people who panic with money, right? Once they put their money there, they are just checking it every time, right? Oh, I didn't make a wrong choice. I didn't make. So it removes that emotional attachment you have with money. Now you're just seeing it as an investment, right? You're not emotionally tied to it because you know either way your money is going to work for you, right? So it makes it easy for you to also invest, right? So it requires no little effort from the buyer, right? Like that's you and I seeking to use this way of getting financial freedom. So it makes it easy for you to invest. It's a very easy approach to you, and it helps you with consistency. So you're able to invest consistently. So it's a consistent way of investing, right? It also encourages you to use a low capital to start investment. So there's low capital involved. You have the opportunity of using low capital. Of course, I use the $10 as an example, $50 as an example, that kind of thing. It can be any amount you're comfortable with, right? It also helps you with risk reduction when you diversify the cost at which the shares are being purchased, so you have lower risk, right? So it's like it just balances out your risk level, like your risk with that investment. So there's risk reduction with dollar cost averaging. So it also allows you time, like I mentioned earlier, for you to focus on other things like your family and other hobbies and passion you have that you might just be interested in. So you can take your mind off this, let your money work for you. You can have a time, a period, a date every month you're doing it, or you could just set an automated, you could make it automated. So some investment platforms, you can connect your bank to it and automate it, or you can leave an instruction with your bank to debit these amounts. And if you want, you can set a reminder of your phone to let you know that every day of this month you have to do this. So there are different ways to stay committed, right? And it just removes that timing for you, and you can use that time for something else. So like just know it only happens this period, right? So key points there is the advantages it does: removal of emotional attachment, helps you to diversify your portfolio, helps you use a minimum capital, right? Gives you peace of mind, creates time for all that stuff. You're able to diversify, right? So the higher exposure you have to it, the lesser risk your money has in the market, right? So you have low volatility when you diversify your investment capital through dollar cost averaging, right? So when you're also committed, it helps you build that confidence. So it gives you that consistency. So with your frequency, like, oh, every month I'm doing this, or every week I'm doing this, it gives you that self-confidence, gives you that assurance. It also sets you as a good example to people around you. It also makes you feel fulfilled because you know you're doing something for yourself and you're consistent with it. It can also help you in other areas of your life, right? If just little steps, like you see growth, right? And then it helps you also diversify into different asset classes, right? So is those are some key points for you to note. So I hope that I have been able to educate you efficiently as possible, without confusing you. I try to go as elementary as possible on how to use dollar cost averaging to invest. So if you're still on that bed, not knowing if you should make that move to commence investment, I encourage you to start with what you have now. Try and practice dollar cost averaging. I believe regardless of wherever you are, that's whatever province you are, whatever country you are, you can actually practice dollar cost averaging, right? If you have any questions, any clarification, feel free to shoot me a message. Drop your comments. I want to know what you feel about this. Thank you and have a good day.